Now speaking, Aaron Turner, Head of Investor Relations. Smartsheet reported their first quarter of fiscal year 2024 earnings results after the market closed today. CEO Mark Mader and CFO Pete Gobellet discussed the results on the earnings call. The call was webcast and is available for replay on their investor relations website, investors.smartsheet.com. During the call, forward-looking statements were made which are subject to risks and other factors such as those described in their SEC filings. Non-GAAP financial measures were also discussed with a reconciliation to the most directly comparable U.S. GAAP measures available on their investor relations website. With that, Mark Mader took over the call. Now speaking, Mark Mader, Chief Executive Officer. Thank you, Aaron, for your overview of the first quarter's performance. In Q1, Smartsheet revenue exceeded guidance and grew 31% year-over-year to $219.9 million, and billings grew 20% year-over-year to $215.5 million. Non-GAAP operating margins of 10% were more than double the high end of the guidance range, and free cash flow was $31.3 million. Smartsheet ended the quarter with an annual recurring revenue of $886 million and 12.8 million users. There were 59 customers expanding their Smartsheet investment by more than $100,000 and 188 companies expanding by over $50,000 in Q1. Enterprise expansions included Eli Lilly, Motorola Solutions, Foxtel, and Novacure among others, and new customer wins included Liberty Media, Hostess Brands, and 811 Group. The company launched a free plan worldwide with high engagement and conversion to paid in every customer size segment. Smartsheet's three dimensions of work, people, content, and work are helping customers drive efficiencies across their entire Smartsheet ecosystem and expand value to partners and customers. The company is investing in scalability of their platform and making improvements to dashboard capabilities. Smartsheet is focusing investments in three Gen AI areas: an intelligent assistant, project and portfolio intelligence, and image manipulation/auto generation of video captions and image descriptions. These features have potential to create additional revenue opportunities in FY 25. Now speaking, Pete Gobellet, Chief Financial Officer. The company exceeded their Q1 revenue guidance and delivered a non-GAAP operating margin of 10%, more than double the high end of their guidance range. However, they are electing to remain conservative with respect to their full-year guidance due to the macro environment. Q1 revenue came in at $219.9 million, up 31% year-over-year. Subscription revenue was $206 million, representing year-over-year growth of 33%. Services revenue was $13.9 million, representing year-over-year growth of 7%. The number of customers with ARR over $50,000 grew 33% year-over-year to 3,343, and the number of customers with ARR over $100,000 grew 42% year-over-year to 1,569. Domain average ACV grew 18% year-over-year to $8,520. Dollar-based net retention rate encompassing all customers is 123%. Total gross margin for the quarter was 82% and subscription gross margin was 86%. Operating income in the quarter was $22.8 million or 10% of revenue, a 6 percentage point sequential margin improvement. Free cash flow in the quarter was $31.3 million. For Q2, they expect revenue to be in the range of $228 million to $231 million and non-GAAP operating income to be in the range of $7 million to $9 million. They expect billings to grow sequentially by around 6% and accelerate sequentially from Q2 to Q3 and from Q3 to Q4. For the full fiscal year, they are reiterating their guidance of $943 million to $948 million, representing growth of 23% to 24%. Non-GAAP operating income is expected to be in the range of $43 million to $53 million, representing an operating margin of 5% to 6%, and non-GAAP net income per share to be 37 cents to 44 cents. Billings growth is expected to be 20% and free cash flow is expected to be $110 million. They are investing appropriately to drive top-line growth with a focus on efficiency and believe they will have a long runway of sustainable growth and margin expansion ahead. Truist Securities analyst Terry Tillman inquired, "Mark, how much should we expect the enterprise business to grow this quarter? Is a 40% ACV growth a good benchmark? How many customers have an ACV over $1 million? Mark Mader replied, "Terry, we added 85 customers over 100K this quarter. Our platform is well suited to meet the needs of enterprise customers as they look for productivity wins and how to maximize higher value activities. We offer solutions in three key areas: people, content, and work. Customers are taking their time to gain confidence before making a purchase decision, which leads to a longer sales cycle for larger opportunities, but there is still strong interest in our offerings in that upper band." Truist Securities analyst Terry Tillman inquired, "Can you provide some context to the 20% billings growth guidance for the year and explain the puts and takes that make up this conservative estimate?" Pete Gobele replied, "In setting our guide for the quarter, we saw some softness in our high-velocity transactional business associated with SMB and mid-market customers, which we had seen before during the COVID pandemic. The rest of our business performed according to our expectations given the macro environment we anticipated. What we did see was lengthening sales cycles, which is typical for enterprise customers who often have more back-end loaded budgets. This means that more opportunities will push into the back half of the year. To reflect this, we are maintaining our guide on billings, but it takes into account both these effects as well as the timing of when deals happen." Needham & Company analyst Scott Berg inquired, "Can you comment on the seasonality we've seen with larger enterprise deals this year and whether it's likely to persist?" Pete Gobele replied, "Scott, enterprise budgets and cycles tend to be back-end loaded. We must take into account the macro environment when budgeting, as many companies are doing the same. This will influence how the macro plays out in the coming year." Needham & Company analyst Scott Berg inquired, "Mark, what impact has the traction of the free plan had on bookings and billings this year? Is it a material driver or will it have a greater impact in fiscal 25? Mark Mader replied, "Scott, we were pleasantly surprised to see that a significant number of organizations trialing free and operating in a free environment had more than 10,000 employees. Conversion from free to paid exceeded the trial conversion rate, which was encouraging. There are hundreds of new paid customers joining our platform every month who wouldn't otherwise be with us. On a contribution basis, these new customers are still small but over time can become meaningful contributors. We focus on enterprise excellence and lowering the leading edge for our customers, which will pay dividends long term." Jefferies analyst John Bune inquired, "Can you provide more details on the linearity of Q2 billings and share insights on verticals?" Pete Gobele replied, "Q2 was a positive quarter for us, with significant contributions from our second and third months. We saw the close rates follow seasonal patterns which we had seen in the previous quarter, and May looks very much like February in terms of closed rates. Despite having a higher pipeline, we have seen similar deal dynamics, such as deal cycle elongation and compression." Guggenheim Partners analyst John DiFucci inquired, "Mark, how have customer conversations evolved this quarter compared to last? Are there any differences in enterprise versus SMB or mid-market sales cycles?" Mark Mader replied, "John, one of the things that worked well for us this quarter was companies shifting workloads to Smartsheet. We saw a travel company retire an old marketing system for our app, which they viewed as a double win. They get an app their team is asking for and they can consolidate operations. People are looking more for confidence in their investments, so they want to understand the ROI of their spend beyond just qualitative factors like liking the app or feeling more productive. This emphasis has increased slightly, but there hasn't been a major deviation from the past 2 quarters." Guggenheim Partners analyst John DiFucci inquired, "How have the software model and active management of the business contributed to strong free cash flow despite a tough macro backdrop?" Pete Gobele replied, "The natural scale in our model is coming through strongly and contributing to cash generation. We provided a guide of $110 million for the full year, compared to sub-$10 million the previous year. Additionally, we are improving profitability by becoming more efficient, reducing operating expenses that are not tied to revenue, and using cost-effective locations. Both these factors are significant contributors to our success, but the business model itself is the predominant one." Barclays analyst Ryan McWilliams inquired, "What early thoughts do you have regarding adding generative AI or ChatGPT to your capability-based offerings?" Mark Mader replied, "I believe the analytics AI component we are releasing shortly, paired with our control center capabilities, will be a huge benefit to customers. This offering will dramatically reduce the cost of analysis by allowing customers to ask questions, instead of having to build dashboards and widgets. We will launch this with beta customers next month and I expect it to have a significant impact on customer success and support deflection. The assistant feature will also unlock greater value on unique Smartsheet calculations, significantly reducing round-trip time on support, leading to a better customer experience." Barclays analyst Ryan McWilliams inquired, "What deals slipped out of 1Q and did you see any early signs of stabilization in higher velocity transactional opportunities?" Pete Gobele replied, "We've seen consistent close rates on our deals, nothing unusual has emerged." Oppenheimer & Company analyst George Iwanik inquired, "Pete, could you tell us how the macro environment is impacting sales productivity?" Pete Gobele replied, "George, sales productivity is declining due to the macroeconomic environment. Our sales teams are doing a great job of generating opportunities, but the actual close rate is lower than in prior quarters, resulting in decreased overall productivity." Oppenheimer & Company analyst George Iwanik inquired, "Can you provide more insight into your plans for direct marketing and partner engagement in the second half of the year?" Pete Gobele replied, George, we are launching additional marketing initiatives to drive high-value conversions, which will be reflected in our second-half bookings. We have seen reliable cohorts develop with the approach we've taken over the last quarter, providing us confidence in our second-half guidance. Wells Fargo Securities analyst Michael Berg inquired, could you explain how changes in conservatism or assumptions may impact the margin guidance going forward? Pete Gobele replied, our margin guidance for the year is $43 million to $53 million, and we feel confident in that range. We increased it from the previous guidance of $35 million to $45 million. This will allow us to make investments while staying within our guidance. As the year progresses, we'll adjust our investments as needed while maintaining our guidance. Wells Fargo Securities analyst Michael Berg inquired, what hiring changes have you made in response to macroeconomic conditions, and how has it impacted margin performance? Pete Gobele replied, we've made some strategic hires in key areas that are helping the organization progress. We've identified a few additional positions that we plan to fill, but overall, our hiring is not increasing significantly this year. We're taking a wait-and-see approach to how the macroeconomic environment develops before making any larger investments in staffing. Wolfe Research analyst Ethan Bruck inquired, what investments are you expecting to make this year that impact the operating margin guidance while leaving the cash flow unchanged? Are there any changes in go-to-market strategy from the free offering that could result in an improvement of margin targets for the year? Wolfe Research analyst Ethan Bruck inquired, could you explain why the margin guide was increased while free cash flow remained unchanged for the year? Pete Gobele replied, our operational margin is in line with our guidance and consists of revenue closely linked with billings and free cash flow. We have not changed our guidance for billings or free cash flow, but we have applied efficiency gains to our operational margin guidance. William Blair & Company analyst Jake Roberge inquired, Pete, what is driving the projected billings growth acceleration in the back half of the year? Are there any risks that could cause some of the larger deals to be delayed into fiscal 2025? Pete Gobele replied, essentially, we've examined our larger deals and close rates and noticed they're taking longer in the sales cycle. With customer budgets being heavier in the second half, combined with factoring in potential deal push-outs, we feel confident in our FY 24 guide for billings and revenue. Additionally, we've started investing in a new marketing program aimed at customers with a high lifetime value and return on investment. This is also factored into our guide. William Blair & Company analyst Jake Roberge inquired, could you provide more information on the demand for Advance's newer products and how changes in the macro environment have affected the prioritization of their platform solutions? Pete Gobele replied, we are seeing great traction for our products, especially Advance. We have seen 143 customers either buying or upgrading to a tier in Advance due to its proven ROI and simplicity. Additionally, customers are taking the approach of buying individual capabilities, such as Data Shuttle, as they start on their journey to purchase more of our product portfolio. FBN Securities analyst Shibli Sirafi inquired, can you explain the reasoning behind maintaining the same annual revenue range when Q1 revenue was higher than expected? Pete Gobele replied, given the macroeconomic environment, we've taken a conservative approach to our guidance for the year. We believe this provides us with the flexibility to adjust as needed in the future while ensuring that we are meeting our stated goals and objectives. Despite the strong performance seen in Q1, we have elected not to change our guidance at this time. Pete Gobele replied, our international performance was in line with our expectations. We experienced headwinds but the results were as projected. JP Morgan Chase & Company analyst Pinjalim Bora inquired, are you piloting self-discovery of capabilities with customers? What are the results? Does this include self-serve purchasing online, or does it still require sales effort? Is there any benefit from this expected in the second half in terms of bookings? Mark Mader replied, we are introducing in July a new discovery and usage feature to enable customers to quickly find and take advantage of our products. This will reduce the time it takes to order, as a customer can identify and use the product they need without needing assistance from a member of our team. We expect this to lead to increased cross-product attachment, as currently less than 10% of our customers purchase more than one product. JP Morgan Chase & Company analyst Pinjalim Bora inquired, Pete, could you please explain what led to the decrease in deferred revenue? Was it due to SMB and mid-market weakness or longer sales cycles? Pete Gobele replied, the large contributor to our quarterly earnings was the high-velocity transactional business associated with SMB and mid-market. Demand for our marketing solutions and the elongation of sales cycle were also significant factors. JP Morgan Chase & Company analyst Pinjalim Bora inquired, could you provide an update on the competitive environment compared to early last year and what win rates have looked like? Additionally, how have you seen the rollout of your newest tool drive standardization in customer use cases? Mark Mader replied, over the last 2 years, we have seen an increase in our conversion rate and win rate on new business. This serves as a planting of seeds that will eventually yield a greater return for customers who use Smartsheet to unify content, people and work into one platform. We have not seen any competitors in our category make moves to do something similar, but the status quo remains the leading competitor. In the next 2 years, this is unlikely to change. KeyBank Capital Markets analyst Jason Celino inquired, what is the plan to drive interest in the free plan customers, and will it be mostly paid marketing driven? What is the opportunity to convert free users to paid users over time? Pete Gobele replied, we've launched marketing programs to target high-value conversions and customers with a high lifetime value, LTV. Although this isn't our primary focus, it has helped to boost the popularity of our free plan. In addition, people are discovering these free plans as they look for ways to address their collaborative work management needs. This has had a significant impact on our growth. Mark Mader replied, we're seeing great success in getting people engaged in free and converting them to paid customers with our product suite. Our AI-driven experiences have resulted in a higher than average conversion rate from free to paid, allowing users to experience premium features that continue to drive growth. We are continually adding new companies to this realm and closely monitoring the conversion rate as we introduce new capabilities. Morgan Stanley analyst Josh Baer inquired, Mark, how have customer conversations evolved around AI and what timeline are they expecting for implementation? What additional AI use cases are you considering beyond the 3 main ones you outlined? Mark Mader replied, we serve a diverse range of customers across multiple industries, from manufacturing to education to health to technology and services providers. AI conversations vary from highly educated prospects who want to understand the technology in depth, to those who need basic education on it. Our goal is to become a trusted advisor, providing them with the knowledge and security they need. We use open AI and large language models that don't leave our boundary, allowing us to maximize value for our customers at every stage of their journey. Our AI strategy is built on customer activity, from assistance to analytics to content generation. We are constantly learning about customer needs and sensitivities as we deploy our AI strategy and look forward to further insights in the coming year. BMO Capital Markets analyst Keith Bachman inquired, can you provide more clarity on the billings guidance for the back half of the year? Specifically, when you mention conservatism, are you referring to both the October and January quarters or just the January quarter? Additionally, why does this 6% sequential growth imply 11 to 12% year-over-year billings growth? Pete Gobele replied, Keith, to answer your question, we expect a 6% sequential increase in Q2. We have seen elongated sales cycles, but the deals are closing. Enterprise budgets are set up for the back half of the year, and we have made investments in marketing programs that convert to expected bookings contributions. Our guidance on billings takes into account macroeconomic factors as well. BMO Capital Markets analyst Keith Bachman inquired, are you assuming an improved close rate in or a better macro environment to reach your goal of $20 billion in deal elongation by year-end? Pete Gobele replied, we're operating in a macro environment that is not expected to improve. We expect enterprise deal cycles to remain longer, however our closed rates are expected to increase. The comps will become easier in the third and fourth quarter due to the macro environment already having an impact on our results last year. In light of these factors, we feel good about how the year will play out. D.A. Davidson analyst Robert Simmons inquired, can you provide an update on the success of your partner ecosystem initiatives and how much new business has been generated as a result? Pete Gobele replied, we continue to see strong growth in partner touch revenue, increasing from the single digits last year to the mid-teens in the current quarter. Our partners bring unique capability and are an integral part of our go-to-market strategy, particularly in international markets. Mark Mader replied, our reliance on third-party partners to bring in business is a small minority of our total, although they have been instrumental in co-selling. This has accounted for less than 15% of our total business. D.A. Davidson analyst Robert Simmons inquired, what is the progress of the large SIs building out their practices? Mark Mader replied, we anticipate having news about Smartsheet in the second half. We have 2 large SIs building service delivery practices on Smartsheet who are leaving it behind with customers after projects. This is distinct from system implementation and config services. We'll have more information to report on this in the second half. Credit Suisse analyst Fred Lee inquired, what strategies have you implemented to protect against customers downgrading to free in a weaker macro environment? Mark Mader replied, we conducted extensive design work and research prior to launching free last year, and were very careful in our approach. We identified that the need for sharing within organizations and customers was significant. Currently, you can share with up to 2 people, but have not seen any impact on conversion to our paid plans or downgrading to free from existing customers of any significance. Our research prior to launch showed no evidence of this and we have continued to observe the same since launch. Credit Suisse analyst Fred Lee inquired, Pete, last quarter you said NRR would end in the high teens. Did you give an update on that? Also, could you comment on pricing and whether it has been stable or if there has been any sequential degradation from Q4? Pete Gobele replied, "We anticipate our net dollar retention rate to finish the year in the high teens, which is in line with what we had previously stated. We have not observed any significant reduction in prices, though we have noticed a decrease in demand for short-term projects that can be quickly executed." Aaron Turner replied, "Thanks for joining us today. We look forward to speaking with you again next quarter."